every month we're seeing gold and silver being delivered at levels no one's ever seen, ever. 26 million ounces was one of the smaller delivery months for the last 18 months, but 39 million ounces, 2 million pounds worth of silver got on trucks and drove out of COMEX. The question is, who in God's green earth is doing that? Who is standing for possession for 2 million pounds of silver, running logistics, insurance, and where is it going? Who is it? Is it the Exchange Stabilization Fund? On behalf of the US government, now that silver is a critical mineral, they don't have to ask if it's national security for congressional approval. My point is that, yes, structural things can actually distort. Fundamentally, the story is as strong as it's ever been, and the biggest money in the world and the most well-informed money, France repatriating all their gold, no counterparty risk. These big countries are less concerned with structural and more concerned with fundamental.
Much of silver's rally is being driven by China, not Western investors. Reports show silver prices surged earlier in 2026, largely due to Chinese retail buying and industrial demand, with local premiums rising sharply. China's demand for precious metals is surging sharply. In March 2026, China imported around 836 tons of silver, the highest ever recorded, driven by strong retail buying and massive solar industry demand. At the same time, gold imports also hit record levels, confirming that China is aggressively accumulating both metals. Prominent figure in the precious metals industry Andy Schectman emohasizes that the sharp drop in gold and silver earlier in the year was mainly structural rather than fundamental. He explains that forced selling came from leveraged rebalancing and a major margin increase by the CME Group, which pushed traders to liquidate positions rapidly. According to him, this created a cascade of selling that distorted prices even though the underlying fundamentals of precious metals remained strong. Moving forward, Schectman further mentions that after this price drop, countries like China aggressively increased their silver imports, while large amounts of physical metal were taken out of the COMEX through record deliveries. This trend signals a deeper shift, where major institutions and nations are prioritizing physical ownership over paper markets. He suggests that this growing demand for real metal could eventually lead to a repricing of gold and silver, as physical shortages begin to override the influence of leveraged futures markets. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Andy Schectman's recent interview.
Well, I think structural is a good word. That's the term that Bank of International Settlements used recently to describe the watershed flash crash in precious metals we saw earlier this year in January, where they came out and publicly said, and I looked at it as almost taking the West and the CME Group to task. Maybe I'm looking at it from a minority perspective, but look, they said that the crash in gold and silver was largely structural, not fundamental. Because in January, typically the first week in January, you have the rebalancing of the levered ETFs. And these ETFs, which are 2-3 times levered, some of them had really gotten distorted by silver and gold's precipitous run week over week leading into the end of the year. So they had to rebalance it. Now, they also, at the very same time, in my argument, would be the worst time ever to do what they did. The CME Group raised margins by 300% from December to first, second week in January, crushing the speculator, making them post 3 times the money that they had a month earlier in margin as collateral, and also companies who, like mine, or refineries that have to hedge their positions, making it 3 times more expensive. So the combination of the rebalancing of the ETFs, which in essence you had to sell to rebalance, the selling created more selling, beget more selling, beget more selling, along with the margin increases more and more and more and more, and bang, the whole thing collapsed. And it's interesting because when that happened, we'll use silver as an example, in the month of February and March, after silver had gotten its teeth kicked in, and we'll use silver as an example here, not just gold, same thing with gold, but silver really stark. China imported more silver in February and March than they ever have in recorded history, ever, after the price was decimated. And to me, price is a tool of misdirection, where a lot of the countries in the world said, thank you very, very much, we'll stand for delivery. Well, the same thing is true here in the United States. In February, about 26 million ounces were delivered into COMEX. Now, this is a trend we've seen for 18 months, Elizabeth. Every month, we're seeing gold and silver being delivered at levels no one's ever seen, ever. 26 million ounces was one of the smaller delivery months for the last 18 months, but 39 million ounces, 2 million pounds worth of silver got on trucks and drove out of COMEX. The question is, who in God's green earth is doing that? Who is standing for possession for 2 million pounds of silver, running logistics, insurance, and where is it going? Who is it? Is it the Exchange Stabilization Fund? On behalf of the US government, now that silver is a critical mineral, they don't have to ask if it's national security for congressional approval. My point is that, yes, structural things can actually distort. Fundamentally, the story is as strong as it's ever been, and the biggest money in the world and the most well-informed money, France repatriating all their gold, no counterparty risk. These big countries are less concerned with structural and more concerned with fundamental, and using the structural environment, I think, to stand for delivery at subsidized prices. And in the case of repatriation, it's a trend we've been continuing to see, where whether it be off of COMEX, where once that 2 million pounds drives away in semis with insurance, it's never coming back. You'd have to drill and fill those bars just to re-assay them, to reintroduce them at a high cost and huge time lag. So whether it's big investors here, or whether it's France or India or Germany or the Bank of Austria, Hungary, Turkey, Poland, the Czech National Bank, the Dutch National Bank, all bringing their gold back from the Bank of England, the New York Fed, at the expense of ease in favor of no counterparty risk, the fundamentals that have, I think, really started to exert themselves are using the structural issues or the structural dislocations to their advantage. So this is less structural to me and far more fundamental. See, the only place on the planet where the price is calculated is on COMEX. And you have a situation where price is a tool of misdirection. In my mind, price is absolutely a tool of misdirection. And China proves that. There are people out there calling it the Shanghai flip, where, whether it be in gold, when gold got crushed in January, there was an $80 premium in Shanghai. That tells you it's not fundamental, it's structural. They want it. Or silver, where they imported more silver over 2 months than they ever have in history. I think this is something that is going to you will continue to see this, because the world is realizing, I think, and look at, for example, BlackRock. I mean, BlackRock piggybacking rather, off of the chief investment officer of Morgan Stanley. Sell half your bonds, he said, put that 20% into gold. The 60-40 rule that they talk about is dead, he said. 60-20-20, 20% gold, 20% bonds, 20% or 60% stock. Michael Hartnett, the chief analyst of Bank of America, he said, no, 25, 25, 25, 25. Short-term treasuries, bonds, stocks, and precious metals. Jeffrey Gundlach, the bond king, no, 25% in metals is not overweight. BlackRock just said the exact same thing. That 60-40 rule is now dead. We're going to reposition things much more so into commodities and precious metals. How about the banks? Wells Fargo saying $8,000 by 2027. UBS, JP Morgan, Bank of America, all targeting $6,000 to $7,000 in the next 12 to 24 months. And the lead metals trader for Bank of America, forget about Michael Hartnett, who's the lead analyst, lead metals trader said potentially silver could go from 130 to 309 by the end of this year. Now, all of these things, that they don't mean anything, right? It's just a guess and a projection. But when you are seeing big banks, when you are seeing huge deliveries, when you are seeing repatriations, when you are seeing metal leave the COMEX, that's beyond the delivery, that's a loadout. These things you never saw before, never. Gareth is an expert in technical analysis. I'm sure he would tell you that less than 1% of contracts, my entire 35-year career, stood for delivery. Less than one. And the amount of deliveries we are seeing right now are so far off the chart. Elizabeth, it's like 4 feet of snow in my backyard here in Boca Raton in August. I'm not going to call my sister back in Minnesota and say, hey, my 2 snowmobiles in your garage, ship them down here because I'm going to go for a ride this week on the golf course in August with 4 feet of snow. It's an anomaly. And so many of the things that we are seeing from a historical perspective are anomalies, and they put them together and they carry much more weight, that things are changing, whether it be an outright reset or just over time, where the physical possession starts to overwhelm the manipulative, leveraged, really silly price structure that the COMEX is enabled to to create through levered futures contracts, where it's the tail wagging the dog instead of the underlying commodity creating the price. It's the levered, speculative, gambling casino futures market that creates the price. And that's inverse of how it should be. And I think that's starting to change a little bit.
During the interview, Andy Schectman explains that the idea of rising interest rates hurting gold is misleading. He argues that the real issue is declining trust in fiat currencies, as countries like China reduce U.S. Treasury holdings and shift toward physical gold and silver. He emphasizes that even in a high-rate environment, gold has surged, showing that currency debasement and global uncertainty are the true drivers. Large players use price drops in futures markets to accumulate metals quietly, while retail investors focus on short-term volatility. China increasing imports of gold and silver while tightening control over exports signals strong domestic demand and strategic accumulation. At the same time, central banks worldwide continue heavy gold buying, and geopolitical tensions are keeping safe haven demand elevated. China is systematically diversifying its foreign reserves by reducing U.S. Treasury holdings to multi-year lows and aggressively purchasing gold, which has reached record levels above 2,300 tons. This shift aims to reduce dependency on the U.S. dollar, mitigate geopolitical risks, and hedge against U.S. debt devaluation. Let's get back to the interview.
There's this war, and so you have oil that goes up in the Middle East, which raises the CPI, which raises inflation, which means the Fed can't be dovish. They have to be hawkish. They're not going to lower rates, so gold's going to perform poorly. That is flat out crap. And it's crap because that's what they want us to believe, right? That's managing things. You don't want to run to gold when things are bad with the dollar because, rates aren't going to go down. First of all, let's look at that. If they raise rates, so what? Who wants to hold the dollar in the Treasury anyway? It's less about return and more about trust. Look at China. They've dumped half of their Treasury holdings. When we crossed the Rubicon with Russia and stole their treasuries and gave it to in the form of weapons to the Ukraine, that's a line you never come back from. And I say that to you because look at from the other side. They look at us and say, you guys went into Iraq 23 years ago under false pretenses, never found those weapons you were looking for. You're still there after destroying their country, but you can pass judgment on another country for doing what they feel they need to protect their own sovereignty. You can kick them out of SWIFT and take their treasuries, but you do something that if the shoe were on the other foot, there'd be ramifications and there are none for you. So you're judge, jury, and executioner. We don't want to hold your treasuries anymore. If it was a word, it would be called de-treasurization, and it's happening at a massive clip. So I think that is something that is growing. And when you talk about what crap it really is, it's a convenient argument for those people to make that statement, but to ignore the fact that during the pandemic, the federal funds rate was pretty much plastered to the floor at or about zero, and then went to 4.5% in about a year, a 450 basis point increase, the fastest ever. And what did gold do? Oh, that's right. It was 1,800 when it was at zero, and it's at 5,000 nearly, or 4,500, 4,600, 4,700 now. It's tripled in a rising interest rate environment. It's convenient to ignore that, to say that, they're not going to pivot and lower rates, so gold's going to do poorly. It's crap. Now, if this was a currency that everybody wanted and our treasures that everyone was clamoring for, yeah, I would buy that. But this is the antithesis of that, the late stage game where demand for treasuries and demand for dollars that are being inflated away by our less than astute fiscal responsibility, kind of like a kid in a candy store with mom's wallet, is a joke. And I think this is management of perception economics. And what betrays that are the deliveries. So the biggest money in the world uses that rhetoric, uses the suppression on COMEX through raising margins to the moon at the exact same time you're rebalancing levered ETFs to create an environment of cascading selling. And who stands for delivery at the highest level ever? Oh, that's right, the central banks, including China, including whoever's doing it here. Misdirect through price, through rhetoric. When everyone's looking over here, you're scooping it up. Don't tell. That's what's happening. And it's crap. It's a crap argument to me, and one that is very convenient for the talking heads that have missed all of this. Those same talking heads have missed who the hell is standing for delivery for 18 straight months. Who's pulling 2 million pounds of silver out in February? But we're seeing that every month. Lots of metal leaving, more so coming in. It never happened before. That's the story that is being missed completely and totally. Price and narrative and what used to be and recency and normalcy bias, all that stuff, it doesn't, because the biggest money and the most well-informed money who know where the puck is going. They used to ask Gretzky, how are you so damn good? You're a little guy, because I skate to where the puck is going, not to where it's at. And these people who are spending 9 figures every month, they know where the puck's going. That's the story that has been missed. That is the story that betrays all of this conventional wisdom by the talking heads. So no, I think that's just managing the perception, and they're taking advantage of it themselves. Let's look at the Asian countries. 35% of global GDP, China's largest trading partner, will not be trading nearly as much. Anything they trade with China won't be in dollars. It'll be in yuan, right? Or their local currencies. So all of these countries selling their commodities, their resources, or just trade in local currencies chips away at the dollar settlement system greatly. And then if you don't hold dollars, like the whole part of the petrodollar deal is you'll sell oil in dollars and then reinvest all of the dollars you're holding in treasuries to earn a yield, lowering our rates, raising our asset prices, making the goods that we buy at Walmart cheap. That exorbitant privilege is coming to an end, because these countries don't need to buy treasuries if they're not holding as much in the way of dollars, chips away at the reserve status. So it's the little by little by little by little by little by little, then bang, the whole thing tips over. Now, I'm not saying we're anywhere near that. Maybe we are, maybe we aren't. But you are seeing 40, 50 countries or more show interest and applying to become BRICS members. So it's a growing trend. And if I had to guess, they are waiting for Trump, who seems to be, not really liking these kinds of decisions, perhaps. They're waiting for him maybe to leave office before they start to get a little bit more open and aggressive about it, would be my guess. But the trend is still definitely increasing. It's a real deal. It's a real threat. And these countries, look, you have 2 of the 3 largest nuclear arsenals on the planet. You have the majority of human population, the majority of the commodity production, the majority of the refining. Vietnam just joined BRICS. So between Vietnam and China, you have the majority of the manufacturing. China refines 90% of all the world's rare earths. The countries in China and in that continent, in Russia and in Asia, produce the majority of all the rare earths. Everything they have, it's going from, including trade routes on land, on sea. They are something to not be taken lightly. They are formidable. The difference is this, Elizabeth. People in this country can't deal with anything other than instant gratification. It's not quick enough. And so the Chinese think in terms of years. They cut you 5 million times with paper cuts until you bleed out. Most people just can't deal with how long this takes, and they dismiss it, they poo-poo it. But it's happening if you look very closely. And when they finally do flip the switch, they will be someone not to take lightly in any respect. So it is happening. And this is a broader trend that when you look at our fiscal irresponsibility, our monetary irresponsibility, our policies around the globe, we're not a unified country anymore on many levels, and we're one that's kind of lost its way on many levels. So the world looks at us and says, why would we hold their treasuries? Why would we hold their currency? It's being inflated away. They can print buttons, push a button to print dollars to buy treasuries. It's immoral. Why would we want to hold that stuff? Instead, let's hold gold, which has doubled the performance of the 10-year treasury for 25 years, 10x'd it over the last 2 years, and can't be taken or sanctioned if it's in our own possession. That's why you're seeing all these countries, Germany, France, Poland, Turkey, Hungary, Czech National Bank, Dutch, they're all repatriating their gold. India, from the Bank of England and the New York Fed, foregoing convenience, the LBMA and the COMEX, for security and safety. And that is something that is a trend in motion, but slowly, then all at once, logarithmic decay, it's happening. You got to pay attention, and I think people should. The mainstream media doesn't give any acknowledgement of it. You got to dig, but I think you need to be aware of it for sure.
Near-term technical weakness and a gold and silver price forecast lower levels thesis do not invalidate the long-term structural drivers that have powered precious metals higher throughout 2025 and into 2026. Understanding the distinction between cyclical corrections within secular bull markets and genuine trend reversals is essential for maintaining perspective. Overall, a major structural shift in the global financial system is happening, where confidence in fiat currencies is gradually declining and tangible assets like gold and silver are regaining prominence. While short-term price movements may appear volatile or misleading, the underlying trend points toward increasing accumulation by powerful institutions and nations positioning themselves for a changing monetary order. If central banks and major economies are steadily moving toward gold-backed stability, could the current pricing of gold and silver be significantly undervalued relative to the financial transformation already underway? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.